Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go over the Four Quadrants framework. It's more or less the real estate cycle. I'll go over kind of where we're at in this cycle and where I think we're at, and that is debatable of where I think we are at. Well, it is and it isn't. A lot of people think that we're an inflationary bust. I think that we're an inflationary boom. I'll provide evidence for why I think that and why I think a commodity bull market is going to be sustained. We're in one, and I think we'll continue to be in one for a little while. And I'll show you the evidence of why I think that. And obviously, I can change my mind at any time, given that the evidence changes. But I'll go in here. I'll give you my financial opinion here and what I'm seeing in terms of the Four Quadrants framework. I'll describe it. And someone had posted this asking that I go over it in a video clip. So that's where I got this from. It's from Twitter. If you want to follow me on Twitter, it's at finding_finance. You can find me on Twitter, add me on there, and you can follow some of the discussions I have. So let's go into this. This is the Four Quadrants framework. I threw it in here. This was what was posted. This right here is more or less the real estate cycle. And I can explain to you what that is. Usually what happens is I'm just going to start in the lower left here, the disinflationary bust. Basically, this is a deflation or disinflation bust. That happens in the real estate market. The real estate market goes into a recession. We get a pullback in the liquidity into the system. They call that the disinflationary bust. During that time frame, things contract. You usually see a recession, and that there is when the housing starts to decline, loaning coming into the system declines, and some of the loans go bust, which makes it a deflationary collapse if the loans go bust. In that type of environment, you want to be in government bonds, and you don't really want to be in anything else. As this undergoes and starts to recover, you go into a recovery phase of real estate, and that's where loans start to recover. It means that you transition from a disinflation/deflation into more of a economic growth and more inflationary period. So we're down here. This is a very, we'll call it deflationary bust as you come down. And then as you come back up, prices start to recover. And this is a time where you have a low inflation, low interest rate environment. And really where you want to be here is the technology companies, innovative companies with pricing power. That's where you want to be. You don't want to be with companies with little pricing power or cyclical companies. You don't want to be down here. As economic activity improves and as the real estate market basically turns around and goes more towards an expansionary phase, you'll start to go into an inflationary type movement. Inflation or increase in prices with high economic activity puts you into the inflationary boom cycle. That's where you want to buy stores of value like real estate, gold, commodities, high fixed cost, cyclical producers, and you don't want to be in long-term bonds. That's when your interest rates start to go up, is in the inflationary boom. At some point, the economic activity slows down and you start to move back and down towards the inflationary bust. So you'll cycle up and then you come back down this way. This inflationary bust is usually when the real estate market goes into a hyper supply phase. You get lots of inventory, you build too many homes, there are a lot of inventory out there, the days on the market start to increase, and what happens is your loaning gets cut to the system. The loaning that gets cut to the system is disinflationary or deflationary, depending on the outcome of how many homes are built, on the loans in the system, and what happens to those loans in the system. If they go bust, that is deflationary because you have a credit collapse or a credit destruction. This right here is the deleveraging phase on the left-hand side when prices go down. This is the leveraging up phase between a recovery phase and an expansionary phase. And when you look at potential investments, this is kind of what it looks like. It's rising inflation upward, slowing inflation lower, slowing growth, and accelerating growth. In the upper half where rising inflation is, I prefer to hold gold and commodities. It's on both of these areas. That is where I like to be. That's my, I'll call it favorite spot because of the leverage that you can get to the price moves during a rise in inflationary environment. As this growth or inflation slows, either to the left or downward, you want to go into treasuries and or gold. I prefer treasuries over gold. Gold will go down, but it will go down less. It's basically a safe haven, but it's not as safe as long duration treasuries in a deflationary type collapse. If we were to get a deflationary, sometimes it's just disinflation where the inflation rate goes down. And then the cycle continues. You want to be in this side. I really like technology stocks on this side. And then as you go back up, I go back into commodities and precious metals. So that is the quadrants. That is the four quadrants framework are these. And that's what this is as well. And that is more or less nothing more than the real estate cycle that is driving those quadrants and where we are in the quadrants. Recovery phase, expansion phase. So this is a low inflation, low interest rate environment. This is higher interest rates and higher inflation. Then you go to a hyper supplies phase where everything goes slower. Growth starts to slow, your money supply and inflation slow, all that stuff slows. And then you go into a disinflation or deflation type collapse known as the recession. So the real estate cycle is the quadrant cycle. It's the same thing. What people are going to debate now is where are we in this cycle? And the best way to do it is to look at the real estate cycle because that is what's going to tell you where you're at in those quadrants. And this is part of the thesis of the channel. This is where and how I invest is based off of the real estate cycle or business cycle and where we are in those quadrants. So if we were to look, and this is just another explanation of the real estate cycle, recovery phase, expansion, hypersupply, and recession. You go seller's market on these two, buyer's market on these two. I think that we are in an expansionary phase still in a seller's market. And the reason I think that is because we have decreasing vacancy, we have moderate to high construction rates, moderate to high rental rate growth, and moderate absorption. I don't think that we're here because we don't have increasing vacancy. We do not have low absorption. I think we're in a seller's market and the interest rates are just slowing the expansion phase down. I don't think we're in a hypersupply phase. In order to be in a hypersupply phase, it means you had to overbuild. It means that your inventories are very high. We are building inventories at this time due to a slowdown in interest rates. And that is debatable of where the inventory inventory levels are necessarily going to go based off of where the interest rates are going to go, because interest rates are going to fluctuate. We had a very large increase in interest rate and mortgage rates, which really slowed down the market. And I agree with that. Inventories are starting to come back some, but it doesn't mean that we're out of the woods completely. It means that if rates were to go down, would we see those buyers come back into the market? That is something that I don't necessarily know, and I don't think anyone is going to know the exact amount of people on the sidelines and when they're going to buy when the interest rates hit a certain level. But I think that we're in expansion phase still, and that's where we're at. So this is the real estate cycle. Basically, it just ties together in one big sine or cosine curve where it goes up and down, up and down, up and down of recovery, expansion, oversupply, recession. Recovery, expansion, oversupply, recession, and goes and cycles over time. Over time, the real estate values move in a continuous cycle. In practice, the cycle is never perfect sine wave. Each phase of the cycle will have a different amplitude and period. A complete cycle may take 10 to 15 years. I think the current cycle that we're in is going to be more like 18 or 20 years based off of how long the recovery phase is. So this is your amplitude of your cycle. That is dependent upon the rate of change of your demographic. That is your amplitude. And your amplitude is the size or the impact that that cycle is going to have, or the inflationary impact that it has on the market. So what we're going to do is we're going to look at this cycle here, the recovery, expansion, oversupply, recession, real estate cycle using housing starts. And then you can see the amplitudes of these. And I'm going to draw conclusions over time based off of these findings here. So this is your cycle here, your real estate cycle. And remember, we've got a recession, recovery, expansionary phase into a hypersupply phase, and then the cycle starts again back into recession, and then it cycles over and over and over and over. The amplitude of these moves here are based off of the demographic coming into home buying years. Those demographic coming into home buying years puts pressures on the system through inflation. And what this is, and why this matters, is this here, the amplitude of this move coming up in the housing starts is your volume of loan growth. The volume of loan growth is the inflation in the system. So in 1970, we had a large inflationary period. It cooled back off, and then we went into a recession in 74 onward, 73, 74. And this was the recessionary period. Then we came back into another boom of another demographic that came in. And the demographic actually increased, declined, and then increased throughout the 70s, known as the baby boomers. They were born in the 40s and 50s. This here, if you notice, was one large move higher from 1991 to all the way till 2008. Recovery phase in here. We went into a slight expansion phase, and then we went into an expansion phase all the way in the mid to late 2000s. If you were to pair up the commodity cycles on these, commodity cycle was, commodities were cheap at the beginning of 1970, 68, 70 in this range. And this was your inflationary push. We had them cheap in 99, and this was your inflationary push to create the market conditions where money would rotate into commodities. And what we've got today is a long recovery phase since 2009 onward. We've had a recovery phase, and we just went into an expansionary phase. We are supposedly short, depending on which data you use, between 3 and 7 million homes. And that depends, and it's highly debatable on what exactly is the shortage and how they're calculating it, et cetera, et cetera, et cetera. Either way, we are in an expansionary phase that is not debatable, as we are above the long-term average going up. Now, how long this stays up here, what this does, again, it's a trend that we're looking for. This is inflationary. This is where inflation comes from. We also threw into this, we'll call it the soup mix. This mix that we've got of this is a bunch of stimulus money as well. And what we've got here is the expansionary phase of real estate. That is what we're in. Now, could this come back down and dip below and go into a recession based off of this? Now, we can have recessions where this doesn't dip below the average. We had one in the mid-2000s, 2001, I should say, was a recession that our home starts didn't dip below the average. That is the type of environment that I think is coming, is where we could have a recession, technically have a recession of GDP contracting for 2 quarters, or, and I should say not or, and we have a housing starts that remain robust. And I think that will be the case. No one knows for sure, but that's kind of my, at least, intuition, depending on the rates. Now, if we have a recession and they keep the rates high, the recession will be worse in the economy. We could contract worse. If the recession comes and the Federal Reserve basically dips back on interest rates like they did in the 2001 timeframe, I think that pressure, the recession pressure on Federal Reserve will say, okay, we're done cutting rates. We're going to let the inflation kind of run for a little bit. But that's highly dependent on what they think and what they want to do. They may raise rates, get us into a recession, and then cut the rates back. That is a possibility, but it doesn't necessarily ensure that a commodity boom, or oil in particular is really what I'm talking about. It doesn't mean that oil can necessarily fall because we have an energy crisis happening at the same time. This scenario that's happening right now is very similar to the scenario in the 1970s. We had an energy crisis or peak oil in 1970, where we had liquidity coming into the system from the real estate market as seen in 1970s here. That liquidity came into the system at the same time that we had an energy crisis or peak oil in the United States, which blew up oil prices. We have a similar scenario happening right now where we've got liquidity coming into the system at the same time that we have an energy crisis worldwide. that is going to put very strong inflationary pressures in the system, because we have liquidity coming into the system, and we have the liquidity being transferred in the consumer price index through energy prices. This scenario or setup is very similar to the 1970s in terms of an energy crisis at the beginning of it and liquidity coming in the system from real estate. So they're raising interest rates rapidly and mortgage rates to slow the liquidity coming into the system through this loaning mechanism of the housing starts. It's coming in. This is the gateway that it's coming from. It's the loans being made against new homes. So they're trying to slow that down. And by slowing that down, we could cause a recession. But the housing market is robust and it is short. And I don't think the recession will be anything more than, say, something like a 2001 pullback, like a dot-com bubble. I think that's very possible that we get a recession that is like the dot-com bubble, that housing starts remain robust, and that we could still continue to pull through it. That is all speculation that I said right there in terms of the housing starts. Now, usually when the housing starts and the loans get into the system, it takes about 18 months for this money to work its way through the system. Inflation isn't instantaneous. It takes time to work its way through, and that money has to basically buy things and push prices higher and create those demands in the system. And it takes about 18 months, kind of on average. 12 to 24 months is what most people give it. The money is in the system. It just depends on how it's going and floating around in the system. And the mechanism that transfers it into the consumer price index is energy, the energy prices. And if you have a crisis in energy at the same time that you have liquidity coming into the system, you can see rapid amounts of inflation based off of those things. Now, what I'm going to do is I'm going to look at some technical analysis. I'm going to show you some things based off of the price of some of these assets. Now, platinum is one of my favorite metals. It's one of my favorite sectors or assets in commodities based off of the ratios. It is the cheapest asset, I think, of anything in the world on a ratio perspective given history. And the beginning of the last bull market, basically 99 was a buy signal. We could have been buying, and 98. So 98 was kind of the beginning of the buy signal. You could have bought all this platinum in here. We had a big pull up and then a large pullback of 38% or so in the beginning of that bull market. That was in 2001, where we had that recession or that dot-com bubble. Now, if I was positioning in this, the way that I'm playing platinum is I'm buying it off the bottom and trying to sell at the top. I'm not trying to time these little pullbacks in the middle here. I want to ride the whole thing. I want to make as much money as possible and not worry about these little pullbacks. So my approach is to cost average in, buy a whole bunch down here, have it come up, get a pullback, cost average in. Maybe I start cost averaging in at 25% pullback and I continue to cost average in and I continue to ride it higher. And then eventually when it peaks, I'm going to rotate this out somewhere along this lines, somewhere in here, I don't know where, depending on the ratios, into other assets. Whenever the ratios tell me. That is a technique I use to accumulate more physical ounces of metal in my possession as the ratios fluctuate against each other. And I'm only looking at the dollar per ounce in this scenario here. But we had a 38% pullback. We have a 36% pullback. There is a large difference here. This here, platinum was still somewhat expensive to other metals at this time. This down here, platinum is by far the cheapest metal against all of the other metals by a long shot, given the ratios against other metals. So I do think that platinum is incredibly cheap down here at $850 is what I've got when I took the snapshot of this. And I think that platinum is an incredible deal. But one thing I want to talk about is this is a boom here. From 2000 to 2008 is a boom in commodities. We went into a consolidation phase from 2008 all the way till 2020. 2021 is when we broke out of this consolidation phase. And this year's a consolidation. I think what's coming next is similar to a breakout of that consolidation phase, a pullback, and then a run higher. A breakout of that, a pullback, and a run higher. That is what I think is coming. That is what this chart is telling us. This is the consolidation period. This is us bouncing off the cost curve of about $750. That is the cost curve where platinum gets pulled back of production of its high-cost producers. We bounced on that cost curve multiple times, and now we're coming back and hitting it one last time before I think we head higher. Now, again, this is highly dependent on us being in an expansionary phase of real estate, being in that inflationary boom quadrant, and that is where some people could debate, if there is a debate, would be there. But they can't debate that this pattern exists. They can't debate that this was a consolidation phase from 08 to 2022 or 20 to 21. And this pullback in here, they can't debate that the ratios aren't cheap. Those are facts. And they can't debate that the cost curves are $750, $800 per ounce. So those are all facts. And what I do is I align the facts, I align the market conditions, and I say, okay, I'm going to be buying a bunch of physical platinum because the ratios are cheap, meaning that platinum's cheap. That platinum doesn't have much downside risk because the cost curves won't allow it. It means basically that the costs will, if the price of platinum goes below the cost, that those producers will be losing money and they'll cut back on their production, which we've seen over these years. 2006 was the highest production year for platinum, and we've been in decline ever since 2006. 2008 was the peak price of platinum, and production still declined even though price was going higher in 07 and 08. So I think these mines are pretty old. They're tired in South Africa, which is 80% production of platinum, of all platinum produced. And I think that we're going to get another bull market coming up ahead of us. This is the Thomson Reuters Commodity CRB Index. Another thing that you can notice is that you can see consolidation periods. We had a consolidation period in the late to mid 90s, and then we broke out of the CRB index in 2003 in a big way, and we ran higher all the way up to a top of about 460. We had another consolidation period from 08 onward in a falling wedge pattern. This is what I'm basically charting is the fundamentals of the CRB index. This, or more or less, is charting of the real estate cycle. This here is money in a low inflationary environment going sideways in a consolidation period for these assets because money is preferring to be invested in a disinflationary boom. That consolidation of commodities is this quadrant of the disinflationary boom. 08 was the disinflationary bust. The early 08 was the inflationary, I should say 07, 08 was the inflationary bust, and 06 even. And then the boom happened in the mid-2000s, like 2000, 2001, 2002, 2003, 2004, and 2005 was the boom. And we can see that in this chart here. The boom happened all the way till 2007, 2006, 7, and then we had a decline in 07 and 08 was the bust. This here is your recovery phase. This is quadrant 1, or quadrant lower right. Quadrant lower left is when this is declining and goes below the average. Quadrant lower left, quadrant lower right, quadrant upper right, quadrant, and when we get up here, that's quadrant upper left. And then as we come down, so upper right quadrant is the inflationary boom, inflationary bust, go into a disinflationary bust, and then that quadrant lower right is the boom where you want to be in tech stocks. And that's what this is. This is right here. This downward move is lower left quadrant. Then this entire move going this way is lower right quadrant. Then we go into an inflationary boom, which is the upper right quadrant that we're in right now. I don't think that we're in the bust. Now, some people could say, oh, we're going to have this 08 crash. I don't think we're there yet. We're not there yet because we don't have the inventory, at least not yet. So I still think that we're in the inflationary boom until I see the inventory increase and until I see new home inventories increase and until I see the real estate market really get their foreclosures coming up and the interest rates are high and things start to really slow down. I just don't think we're there yet, not identifiably yet. Well, looking at that quadrant that we were talking about, the four quadrants and how this looks like and the thesis of the channel, these expansionary phases that are coming here, we just went into one. The S&P 500 goes sideways during those time frames. A thing to look at is these sideways motions are basically driven by increasing interest rates. And then stocks discount a higher interest rate and they have lower net present values given the future money out there discounted at higher interest rates. And these cycles last a while. They don't last a year or two. They last for potentially 8 to 10 years. And that is where most people, I think, have it wrong, is they think that this stuff just cycles through immediately. Now, you can have a recession like the dot-com bubble happen at the beginning of one of these phases. That was basically the beginning of this phase was the bubble phase, and then we went sideways for a while until we finally broke out in 2012 or whatever. But the bottom that you wanted to buy here was in 2009. If you knew the cycles and the quadrants, you know kind of where to be in what investments you want to be in. But what I think is coming is an inflationary boom, which will last for a little bit. I don't think that the 3 to 7 million homes that we are in deficit of in real estate have been built. We're underbuilt, and I think they're going to have to be built. And if they are built, that will be inflationary because you're going to get new loans coming into the system, a credit expansion phase in an upper right quadrant, which is over here. So I think we're over here, and it's going to take time. We might be in this area for 4, 5, 6 years before we go to this area, which might be a couple of years, 2 or 3 years. We come down here, which is going to be 18 months to 2 years in a kind of crash. We stay down for a little while, which is another 2 years. So the crash happens for a year or two. We stay down for a year or two. This is maybe 4 or 5 years in total of peak to bottom. And then we start to go into recovery phase again. This last phase went from 2009 all the way till, it's 11 or 12 years in length, 11 years. So I think that this phase will be a little bit longer. Could be 8 to 10 years that we're in this upper right quadrant. And we have to basically rebuild all of those homes. So this here, I think, is a first wave, and we're getting a pullback between the first wave and then the third wave that will eventually come. So it's first wave, a second wave down, and then a third wave higher. And the depth of this wave is unknown. The size and length of this wave is also unknown. A lot of people will like to tell you exactly how long all this stuff's going to be. They're going to start making predictions. I don't think that those predictions are necessarily going to be correct. So what I did is I loaded up at the bottom of this falling wedge, created the channel, Finding Value channel in August of 2020, bought a whole bunch of energy stocks and precious metal stocks and physical metals, and I'm riding this from bottom to top based off of the real estate cycle or based off of what we consider to be the 4-quadrant framework, which is the same thing as the real estate cycle. So that's coming through there. We've got the S&P. We've got interest rates. Interest rates are imperative to where money is going and how it's rotating. In a rising rate environment, money likes to rotate more so into commodities and precious metals, less so into bonds. Obviously, bonds are being sold off, and definitely less so into high growth stocks. So bonds sell off and high growth stocks sell off based off of the increasing interest rate environment. Money likes to seek precious metals and commodities in a rising interest rate environment. They do not like stocks, and this here is that 1966 all the way till 1982 is when it broke out. 1966 is right here with interest rates increasing. That's why the stock market did so poorly, was this increasing interest rate environment. What I'm looking at here is we've got a downtrend break on the 10-year yield. This is what it is, a 10-year yield. We've got declining interest rates coming down. We've broken that downtrend, and we're just starting to head higher. Is this a new shift to increasing interest rates? If it's an increasing interest rate environment, what we're going to see in the S&P 500 is probably a prolonged period of sideways action like the 1960s and 70s, like the 2000s, and potentially coming up here recently based off of the increasing interest rate environment. But that highly depends on how inflationary this market is coming up. It also depends on how much liquidity is coming into the system off of the real estate market. And it also depends on an energy crisis where that liquidity gets transferred into consumer price index. Now, when we look at the market balances, this is something that I also look at quite dramatically and in depth, is what does our energy supply look like? And I just chose uranium here to show you guys what the market balances look like of the supply demand of uranium. And what happens is the last bull market was this little guy back here. We had a shortfall or deficit in uranium, and we had a massive price spike during that time frame. We went from a price of very low all the way to like $140. It was a very large move. That's what this deficit looks like. Now, what do you think this deficit's going to do coming up ahead of us? It's a massive deficit. We're in 2022. We're already running deficits larger than what is in this picture a little bit, and we're increasing the deficits going forward. We have liquidity coming into the system from real estate at this time. It is in the system already. And remember, it takes 18 months to work its way through the system. So if they increase rates now, it takes 18 months for those increasing rates to have a full impact on the money supply in the system. The money's already there. It's already causing, quote, the damage, the inflation, so to speak. So it does take time for that to cycle through. We also don't know that we have a crashing housing market like some people are predicting. They are predicting that. I don't see it in the data yet. So remember, we have time. It takes 18 months for this stuff to work through the system. And people can get very scared emotionally, and we could see sell-offs and pullbacks, but it doesn't mean that the increasing interest rates today are impacting the money in the system at this very second. The money's still out there. It's in the hands of people, and it's circulating around. But this is what's coming up, is a deficit which will, in my opinion, drive the price of uranium higher. This is exactly what I look for in the supply-demand fundamentals and the market balance. We also have oil. I've been watching crude oil stocks and days of supply. It is very low. This is a little bit older of a chart. It's not completely up to date, but we continue to draw down on our inventories of oil. There has not been demand destruction. That is a fabricated, I'll call it, that is all fabrication or predictions at this time. It hasn't been seen in the inventory levels. And even if we were to get one inventory boost, it's hard to say that we didn't get it from the Strategic Petroleum Reserve versus something else. There's a lot of things going on where they're trying to manipulate the price and manipulate inventory numbers and manipulate basically everything. But right now, we are declining, and we're running deficits in oil and declining in our inventories. We're seeing that across a lot of different materials and commodities. Nickel's been declining. This is the supply-demand balance going over. We've got lithium supply-demand balance that goes into deficit here at any second, where we're going to go into a large deficit and balance, where we're going to eat through all the inventories. We're going to go through it through graphite. We're going to go through it with cobalt supply, huge deficits coming out in the later 2020s. We've got palladium price that's already doing deficits, and it's already heading higher. And then we've got some of the metals that are most impacted by new technologies, renewables, and electric vehicles. And I went over some of these. So tin, lithium, cobalt, silver, nickel, gold, tungsten, vanadium, graphite, niobium, zinc, platinum, palladium, and salt. And I went over some of these in here. Now, one thing I want to touch on, and I know it's highly debated. Everybody wants to debate this. They say, oh, we're just going to go to a crash. So it's a recession. Everything's going to crash, total recession. All of those big blowout crashes, they started from the real estate markets and a collapse in the leveraging of real estate. We have to see real estate really eat it for that to happen. Now, increasing interest rates can slow the demand down, but in order to really get a blowout crash, you have to have garbage loans in the system, and you have to have a bunch of those loans already loaned out, and then they have to go underwater. The house does. Once they go underwater, people start walking away and they just default on the loan. I don't think we have that type of scenario yet in the housing market. We're not underwater on these homes. At least I don't know anyone who is. And they're higher credit buyers or lenders. And those lenders are in 30-year fixed rate mortgages. I think only 5% of the mortgages have these wacky loans. So I don't think we're there yet. At least that's my opinion. I still think that we're in an expansionary phase until we get the inventory levels higher. Now, we could build those inventory levels quicker than I think, and we'll see it in the data. Then I would switch to quadrant upper left, which is a slowdown in growth and still inflationary. But keep in mind, that is when a lot of these commodities go berserk. Last time we went into that type of scenario, and I'll show you guys real quick here, and why I am so slow on my thoughts and methodical, because if we go back to this drawing here, this was 06, 07 where we started to come back down. What was at the end of this peak, when things started to slow down and our inventory started to basically balloon, that is when uranium peaked. Some of these uranium companies had massive runs in 05, 06, and 07. And we could be very close to that type of scenario even right now. You could miss out on an entire bull market of uranium selling today and not waiting. Now, I'm not trying to scare anyone out of anything, but that is a possibility. Remember, there's an 18-month delay on what happens today and what's felt in the system. That's generally what it takes for inflation or deflation to kind of work its way through. And it's not immediate. Everybody thinks this is all immediate. It's not immediate. Making short-term price predictions where they're measured in weeks or months, I think is almost impossible. And to have it with like a 95% confidence level is what I mean by impossible. What you're dealing with are probabilities and statistics of more like 60%. So the longer, bigger picture view that you take on these charts that I've been doing with platinum and the commodity index and the S&P 500 that we went over in this presentation, we're charting the fundamentals there. On short-term price movements, what you're charting is sentiment and the emotions and the interactions between people, but that can change at any whim very quickly. So you're not charting the fundamentals when you get into a short-term charting duration. You're just charting the interaction and the beliefs and sentiment of people. And that there doesn't drive markets. I mean, it does in a very short-term time frame, but the fundamentals are what drive these markets higher or sideways or lower based off of the real estate cycle. That real estate cycle, and I know a lot of people, they get into the demand and supply and they really dig into it. And what I'm looking for is the alignment. You can have a very good demand supply. If the demand supply goes ballistic, like if it's way out of whack, prices will go higher. They will definitely go higher. We saw that in palladium. We saw it in rhodium. Basically, you got supply demand that was nowhere near balanced, and the prices just went berserk of those. But if the supply and demand are relatively well balanced, and you have some sort of ability to respond to price increases, then what matters more is liquidity and money flows. Liquidity and money flows is the quadrants and the real estate cycle or business cycle. They're all the same thing. And that's what you have to identify. That's why I developed this channel. That's why I developed the website, so you guys can see all of this. I put a lot of these big picture view charting. I put the cycle up there. I have a lot of education on the cycles. What you need to do if you want to make money is you need to learn this stuff. It's not about getting hot tips and stock picks and trying to time things on a monthly perspective. Some people want that. And what you're going to get and what you're going to find is that you're going to get a lower reliability return. What you're going to be basically relying on and having to do is you're going to have to watch the stock market continuously. You're going to have to try to trade in and out, and you're going to have short, small stop losses so you don't lose your butt on it. And what you're doing is you're basically putting everything on the symmetry of the bet. You're hoping that you get some large payouts and you stop your losses very, very small. What I'm doing is I'm taking big, large positions in a bunch of different undervalued sectors. I buy that when the real estate cycle is telling me that they're going to be in favor. I ride it over that cycle. I ride basically upper right and upper left quadrants upward. I sell. I go into bonds, ride the bond market lower, and then you have to look to see what is going to be fundamentally good after that housing market crash or disinflationary bust period. That is what the website's all about. You guys can join the Platinum membership if you want. That is what you learn, is you learn how to invest based off of these cycles. Now, you could take a very long-term approach like Warren Buffett, where all he does is invest and never sell. That also works because then you're just going across the cycles. And some of these companies that have good pricing power and have very good products can work in any part of that quadrant, depending on what they are and how profitable they are and what they're selling. Obviously, you can have companies blow up at any point. And the ones that I like are very similar to Warren Buffett. I like the ones that are boring and they have a product that doesn't change. So something like food products, you can make a lot of money there, insurance products, and those seem to be very profitable over very long periods of time. So I still have some of my investments in like United Health Group, Anthem, and then Chipotle and stuff like that. Those are also investments that do well over long periods of time because their products don't necessarily change. They're not complex. They're not going to be designed out of the world, so to speak, like a lot of the technology companies could potentially be designed out, like Sony Walkmans and stuff like that. So that is another investment approach, and I think that's really smart. You know, if Chick-fil-A was public, I'd buy the heck out of them, definitely. It seems like they make a ton of money. But that's how I invest. That's the cycle. I think that we're in an expansionary phase still, based off of the housing starts in relationship to the average. We're cycling back and forth above the average, which still makes it an expansionary phase. We still have inventory levels that are not at, we'll call it a buyer's market yet. It's still a seller's market, which means that they're low enough that it's still a seller's market. So that, by definition, means that we're in an expansionary phase still. And a lot of people don't realize how long we stay in these phases. They think that we just pop right through them. It's not like that. They stay in these phases for a while. That's why you've heard me say that the time frame of investors, to get your time frame right, is important. These take a long time. And we could be in this expansionary phase for years. Maybe not. Maybe we don't have the deficits that people are quoting that we have. And we'll have to continue to monitor that, and we'll see it in the inventory levels, and we'll see those things change. And that's exactly why I have this channel, is that we're watching all of this. So I'm still long in oil and uranium. I've had no problems with buying more of it. And I think that we're in a pullback between a first wave, then we're going to do wave 2, and then we're going to do a big old third wave at some point. So long that we stay in the expansionary phase of real estate, which is liquidity driven, and we have problems in energy, which is transferring that liquidity into the CPI, or Consumer Price Index, and Producer Price Index numbers. It's transferring all that inflation into it. So that's what I've got for today, guys. If you guys like this content, give me a thumbs up, subscribe to the channel, subscribe to the website, the Platinum membership below in the description link if you want to learn more about these cycles. I have question and answer sessions. We'll have one Sunday at 7 p.m. Mountain Standard Time. That is 7/10, July 10th is when we're going to have that. So I'll put that on the website too. I'll make that update. I just decided that now. And we can go over all those things together, and you can ask questions at that. And it could be on the cycle. It could be about particular companies. It could be about whatever. But it's there to help you guys. So that's what I've got for today. Hopefully you guys enjoyed the clip, and we'll catch you next time. This is Finding Value.